Congratulations! You have accumulated enough liquid capital to drop $50 million on an ultra-long-range business jet. You sign the purchase agreement, hand over the wires, and assume the hard part is over. You expect a seamless teleportation machine. You call, the stairs drop, you fly. That is the romantic delusion every first-time billionaire starts with. And, mathematically, it is completely wrong. Out of 8,760 hours in a calendar year, the average owner flies their airframe maybe 300 hours. Do the basic arithmetic. That multi-million-dollar Titan sits parked in a dark hangar over 95% of its life. But idle capital is not free capital. Hull insurance policies do not pause. Type-rated captains do not work for free. The airframe never stops aging, which is why virtually no high-net-worth individual operates their own flight department. They hand the keys to an aircraft management firm. Here is the Wall Street twist. The management company does not own the jet either. They run a fleet of other people's assets, swallowing all the operational risk, the regulatory compliance, and liability exposure, without holding the deed to a single piece of aluminum. From the outside, this looks like a luxury concierge business. Rich people, leather seats, champagne on ice. From the inside, it behaves like a regulated logistics operation with airline-level compliance rules, razor-thin margins, and constant exposure to catastrophic financial risk. Somewhere between a monthly management fee and a massive charter invoice, most of the cash disappears before it ever becomes net profit. So, where does it actually go? Let us go inside the financial plumbing. Say you are the owner. You have got a long-range jet, something in the $25 million to $70 million range, and you want to keep it simple. You hire your own pilots, your own mechanic, and run your own little private flight department. Sounds clean. Here is the problem. The moment you fly your own airplane for your own personal or corporate use, you are operating under FAA Part 91. Under Part 91, you can fly whenever and wherever you want, with fairly relaxed rules around crew, rest, and airport access. But there is a deadly constraint baked into the rule itself. You are not allowed to accept a single dollar from anyone else to fly on your airplane, which means every hour it sits idle, it earns nothing. It is a pure, unadulterated cost center. Full stop. If you want that airplane to offset its cash burn when you are not using it, it has to go on a Part 135 certificate. That is the same regulatory category commercial charter operators fly under. That certificate unlocks third-party revenue, but it also unlocks a mountain of obligations: mandatory safety filings, continuous maintenance tracking, strict duty time limits for pilots, and constant regulatory oversight. Now think about what it costs to run that infrastructure yourself. You need at least 4 type-rated pilots, a director of maintenance, someone handling safety compliance, and a dedicated dispatcher. Add up base salaries, health insurance, loss of license coverage, recurrent simulator training at flight safety or CAE, scheduling software, and hangar space, and you are well past $1 million a year in fixed overhead before the airplane leaves the tarmac a single time. A management company solves this through classic fleet aggregation. A firm running 50 aircraft spreads that exact same fixed overhead across every tail in the fleet. Suddenly, the compliance infrastructure that costs a single owner $1 million alone costs a fraction of that per tail. The management company becomes your CFO, your HR department, your dispatcher, and your compliance officer, all in one contract. But before any of that, you have to decide what kind of airplane you are bringing into this ecosystem. The tiers matter more than most first-time buyers realize. At the bottom end, a light jet might run $3 million to $8 million. It sounds like an entry-level option, but it is also the tier where the fixed costs of management, insurance, and crew barely make sense relative to the asset value. You end up paying nearly the same baseline overhead as someone with a much larger jet spread across a much smaller hull value. Step up to a mid-size or super mid-size cabin, and you are closer to $10 million to $20 million. This is where most serious buyers land because the ratio of fixed management cost to aircraft value starts to normalize, and the charter market for this size of cabin is genuinely liquid. At the top end, the ultra-long-range category like a Gulfstream G650 or Bombardier Global 7500, you are looking at $25 million to $70 million. These are machines that cross oceans non-stop. They are also the machines where every variable cost crew, insurance, maintenance, dramatically escalates simply because everything about the airframe is bigger and more complex. So, if scale is the ultimate advantage, how exactly does the management firm make its money? You will see a monthly management retainer. Depending on the jet size, that ranges from $5,000 to $25,000 a month. Over a year, that is $60,000 to $300,000 for baseline oversight, payroll administration, scheduling, and record keeping. Here is the secret. That retainer barely covers the management company's internal labor costs. It is not where the business generates real margin. The bigger number is charter revenue. When the owner is not flying, the jet gets chartered out at $3,000 to $15,000 per hour. Sounds lucrative, except standard industry splits send 80% of that revenue back to the aircraft owner to cover fuel, maintenance reserves, and landing fees. The management company keeps only 20% as commission. On an $80,000 transcontinental charter, a 20% cut is $16,000. That sounds decent until you subtract customer acquisition, positioning costs, and trip support. That margin shrinks fast. So, where is the real money hidden? In the plumbing, nobody checks. Fuel purchasing spreads where the firm buys wholesale and marks it up. A 10% to 15% markup on maintenance oversight, and corporate volume rebates from simulator training providers when they book pilot slots in bulk. None of these appear as a dramatic line item on the owner's invoice. They accumulate quietly across dozens of aircraft. This is precisely why some firms deliberately underprice their management. They do not care about making money on it. They want the tail in their fleet so they can monetize fuel spreads and charter volume. Other firms do the opposite. They charge high retainers, deliberately limit charter flying, and sell owners on absolute privacy and guaranteed availability instead. Two completely different business models wearing the exact same uniform. Regardless of the revenue model, one expense category quietly eats more capital than almost everything else combined: crew. A long-range jet requires 4 to 6 full-time pilots to maintain continuous availability. Pilots have strict duty limits, require mandatory rest, and must maintain currency. And these pilots get paid whether the airplane flies or sits in a dark hangar. If the owner does not fly for a month, the crew still draws full salary, health benefits, and insurance. On top of base salaries, every pilot needs recurrent simulator training once or twice a year. That training costs tens of thousands of dollars per pilot annually before accounting for travel and hotel expenses. Furthermore, the business aviation labor market has turned brutal. Following massive hiring sprees by commercial airlines, senior captain pay in private aviation shot up significantly. Operators had to raise compensation rapidly just to prevent their pilots from jumping ship to major airlines. The operational consequence? Some management companies have been forced to turn down new aircraft, not due to a lack of hangar space, but because they physically cannot source enough qualified insurable pilots to staff the cockpits. Payroll is predictable, but the airframe itself is not. That is where money burns at an alarming rate. Maintenance on a business jet is mandatory and non-negotiable. It is triggered by flight hours and calendar dates set by manufacturers, regardless of whether it is convenient for the owner. A major calendar inspection occurring every 6 to 12 years requires stripping out the luxury cabin interior, inspecting the airframe for corrosion, testing avionics, and overhauling landing gear. That single inspection can easily cost $1 million to $2 million, grounding the jet for weeks at a specialized facility. During those weeks, the jet earns zero revenue while fixed costs like payroll, insurance, and hangar fees run unabated. Then there are the engines. Power plants eventually require overhauls, costing millions per engine. To prevent massive surprise invoices, owners enroll in hourly maintenance programs like Rolls-Royce Corporate Care, paying $500 to $900 per flight hour into a reserve fund. And then comes the dreaded unscheduled mechanical failure, an aircraft on ground event at a remote airport. Suddenly, you must fly in a mobile repair team, air freight replacement components, pay hotel bills for stranded crew, and charter a replacement jet for the passengers. One bad AOG event far from home can rack up 6 figures in emergency costs over a single weekend, completely wiping out an entire year of management profit on that single tail. Even when the jet is airworthy, placing it on a Part 135 certificate introduces operational friction. Every charter hour adds airframe wear, accelerates the next maintenance cycle, and degrades the cabin interior. More flying generates more revenue, but it also drives faster depreciation. Then there is the scheduling conflict nobody warns you about. Charter demand spikes exactly when owners want their jets. Most holidays, major sporting events, global summits. The owner wants to fly to Aspen the exact same weekend a charter client offers top dollar for the aircraft. Hand the trip to the charter client, and you destroy owner trust. Pull the jet back for the owner, and you walk away from real commission revenue. If a mechanical delay hits a committed charter flight, an owner can end up stranded without their own aircraft. That is the exact type of failure that terminates a management contract permanently. Private charters are also one-way by nature. A client flies from New York to Miami. Unless another client needs that exact jet flying back immediately, the aircraft must fly back empty. These repositioning legs, known as deadhead flights, can account for 20% to 40% of total fleet flight hours. Nearly half the flying generates zero direct revenue. Dispatchers spend their days trying to solve this routing puzzle. Sometimes, a management firm will accept a charter flight that breaks even or loses a small amount of money purely to reposition the jet into a high-demand hub like Teterboro or Palm Beach ahead of a highly profitable booking the next day. It is a calculated operational loss. Conversely, a flight that looks profitable on paper can lose money once you factor in $3,000 ramp fees, $10,000 winter de-icing applications, and commercial airline tickets for relief crews when duty time limits are breached. Sometimes, declining a charter trip is the most profitable decision you can make. Underpinning this operational web is immense risk. Hull values routinely exceed $50 million. And liability coverage for serious accidents runs into hundreds of millions. A single accident triggers immediate litigation targeting the owner, the management company, the manufacturer, and the charter broker. This is why safety management systems and ratings from auditing firms like Argus and Wyvern serve as the credit score of the aviation industry. Increasingly, insurance underwriters, not management companies, dictate who can fly. They mandate strict minimum flight hours, often requiring 3,000 total hours and 500 hours in that specific airframe type for captains. If a pilot fails to meet the underwriter's threshold, the policy will not cover them, forcing the management firm to walk away from the hire. You can have a full license to pilot, but if they are short on hours in that specific model, the jet cannot legally take off with passengers. In an industry facing a labor shortage, an entire pool of qualified pilots becomes functionally invisible due to insurance constraints. At the same time, insurance premiums across the industry have surged following high-value claims. Those costs pass directly to the owner's bill, fluctuating entirely independent of how efficiently the management company operates. If fleet scale provides purchasing leverage on fuel, insurance, and maintenance, why do not all management companies expand indefinitely? Because scheduling complexity does not scale linearly, it compounds exponentially. Managing crew duty limits, maintenance schedules, owner demands, and charter bookings across 10 jets is manageable. Across 60 jets, the coordination problem becomes insanely complex. Growth forces massive upfront investments in infrastructure, 24-hour dispatch centers, dedicated safety departments, and layers of middle management before the fleet generates the revenue to cover it. Meanwhile, ultra-high net worth owners often despise institutional scale. They want a direct line to a senior executive who knows their exact cabin preferences. As management corporations standardize operations, that bespoke personal touch erodes, creating room for boutique firms to survive. Despite that dynamic, industry consolidation continues. Heavyweights like NetJets, Vista, and FlexJet have spent years acquiring smaller operators to build vertically integrated platforms. They combine aircraft management, charter, maintenance facilities, and brokerage under one roof. The advantage is overwhelming. A client buying a charter card gets upsold into aircraft ownership. That aircraft goes directly into the firm's management fleet. Its maintenance and fuel spending are routed through internal facilities. Margins are captured at every single step of the value chain. This radically lowers customer acquisition costs. An independent management firm must spend heavily on marketing and sales to convince a skeptical jet owner to switch operators. A vertically integrated giant simply converts an existing charter customer who already trusts the brand. Independent operators are left paying retail rates for fuel and maintenance, competing against integrated giants operating on wholesale margins. To understand why trust and financial engineering dominate this sector, look at the spectacular failures when the business model breaks. Consider ZetaJet. Headquartered in Singapore with operations in California, ZetaJet built an aggressive fleet of luxury bombardier aircraft and grew rapidly into an industry darling. But in 2017, internal strife exploded into allegations of executive fraud, unauthorized loans, and millions in missing funds. ZetaJet filed for Chapter 11 bankruptcy. Investigations revealed massive misappropriation and kickbacks from aircraft brokers. When the bankruptcy court rejected reorganization financing, the firm was forced into complete liquidation. Tens of millions in customer deposits and unpaid vendor bills were wiped out. The lesson was clear. A business built entirely on trust can appear remarkably healthy, right up until the moment that trust collapses. And when it fails, it does not decay slowly. It disintegrates in weeks. Fraud is not the only killer. Sometimes, the core economic model is flawed from inception. Look at JetIt. Launched in 2018 with a fractional ownership model around the Honda Jet, the company marketed aggressively low hourly rates, ignoring baseline fixed overhead. That pricing fueled explosive flight hour growth, propelling JetIt into one of the largest operators in the United States. But fractional contracts contained a fatal clause. If an owner's share of the fleet was unavailable, it was contractually obligated to lease an off-fleet charter jet at prevailing market rates to fulfill the flight. It ended up spending over $20 million buying expensive market-rate charter flights just to fulfill those owner guarantees. The math was completely unsustainable. In 2023, JetIt grounded its fleet and entered bankruptcy, leaving over $36 million in liabilities against barely $1 million in assets. Over 200 unsecured creditors from fuel suppliers to charter operators were left holding unpaid bills. A pricing model that appears customer-friendly on the surface can simply be a company quietly liquidating its own balance sheet, one underpriced flight hour at a time, until the capital runs out. So, does the aircraft management business actually make money? It depends entirely on which version of the year you experience. In the optimistic scenario, a management firm operates a fleet of 100 aircraft. An average annual retainer of $150,000 per jet generates $15 million in baseline revenue. Charter commissions across an active market add $8 million. Fuel spreads and maintenance markups add another $3 million. Total gross revenue hits $26 million. Subtract payroll for dispatchers, safety personnel, facility leases, insurance, and administrative overhead of $18 million, and the firm nets $8 million in profit. That is a solid business. Now consider the realistic scenario where normal operational friction occurs. A pilot shortage forces the company to decline managing 5 new jets, cutting expected retainer growth. An unscheduled AOG event on an ocean crossing trip costs $60,000 in emergency logistics. Scheduled inspections on 2 heavy jets exceed cost estimates by $600,000. Insurance rates renew higher across the fleet, adding $400,000 in unrecoverable overhead. And deadhead empty flights tick up slightly because 2 owners demand their jets back during the same peak charter week, leaving empty gaps in the schedule. None of these events represent a crisis or a scandal. They are simply the routine costs of operating a fleet in a below-average year. Run that exact same 100 aircraft fleet through those numbers, and net profit collapses from $8 million down to $2 million, or flips into an absolute loss. The gap between a stellar year and a devastating year is not a rounding error. It is a $6 million swing on the exact same fleet, with the exact same clients, charging the exact same management fees. Nothing about the core business model changed between those 2 years. Only the variables outside the firm's control shifted. Ultimately, where does real profit come from? It does not come from management retainers alone, nor from charter commissions alone. It comes from stacking fleet scale, wholesale purchasing power, intelligent charter yield management, and strict maintenance oversight, and then maintaining that delicate equilibrium over many years. Losing even a single aircraft owner does not just mean losing one contract. It means losing the retainer, losing charter inventory, and losing the purchasing volume that kept fuel and insurance rates low for every other owner in the fleet. The hangar is not the core asset. The dispatch software is not the asset. The true asset is the multi-year trust an owner places in a management firm when they hand over a $50 million piece of capital, trusting that it will be flown safely, maintained meticulously, and billed honestly without them having to micromanage every detail. An aircraft management firm is not fundamentally in the business of flying airplanes. It is in the business of managing someone else's extremely complex, highly fragile financial risk. The private jet is merely the luxury asset wrapped inside that risk. Now, let us step back and look at how this economic reality shapes the broader private aviation ecosystem. When an individual or corporation decides to enter this space, they are faced with a trilemma: buy outright and manage, purchase a fractional share, or buy jet cards and charter on demand. When you buy outright, you assume 100% of the asset risk, depreciation, and fixed overhead. You hire the management firm to handle operational friction, but you still absorb every unexpected maintenance bill, every insurance rate hike, and every drop in residual value. If the pre-owned market for your specific airframe softened by 15% over a 2-year period, that paper loss alone can dwarf every operational cost you paid to the management firm during that entire timeframe. This residual value risk is the quiet killer of private jet ownership. A jet is a depreciating asset that requires continuous capital infusion just to remain legal to fly. Unlike real estate, where land values can appreciate while the physical structure ages, an aircraft airframe continuously loses value while its required maintenance costs climb exponentially over time. By year 12 or 15, an airframe might require an inspection that costs a significant percentage of the aircraft's total market value. If the engines are due for an overhaul at the same time and are not enrolled in the hourly program, the cost to keep the aircraft operating actually exceed the liquid market value of the airframe itself. At that point, the asset becomes financially non-viable. It is worth more dead than alive, stripped for parts rather than flown. This is where the management firm's role becomes hypercritical for asset protection. A competent management team does not just dispatch flights, they manage the asset's depreciation curve. They ensure that every logbook entry is meticulously documented, every service bulletin is tracked, and every modification is performed by certified facilities. In aviation, an incomplete or poorly documented maintenance logbook can instantly knock hundreds of thousands of dollars off the resale value of a jet. The physical metal might be in perfect condition, but without the immaculate paper trail required by regulatory authorities, the asset is crippled. Furthermore, management firms act as a buffer against regulatory shifts. Civil aviation authorities globally are constantly updating mandates, ranging from new avionics requirements like ADS-B out and FANS-1A to evolving noise abatement regulations and international carbon offset frameworks, like CORSIA. For an individual owner trying to navigate these rules independently, keeping an airframe compliant requires continuous technical expertise. A management firm absorbs these regulatory updates across its entire fleet, ensuring that every tail remains legally compliant to operate worldwide, without the owner having to track evolving aviation law. Yet, despite these clear advantages, the relationship between owners and management companies remains inherently tense. It is a business built on asymmetric information. The management company understands the true cost of aviation fuel, maintenance parts, and crew labor, while the owner typically sees only the aggregated line items on a monthly statement. When an owner sees an invoice detailing a $40,000 charge for a minor avionics repair or a $15,000 bill for de-icing on a single cold morning, skepticism is natural. Was that markup fair? Was that repair truly necessary? Could the fuel have been purchased cheaper at a neighboring FBO? This inherent information asymmetry is why transparency has become the new battleground in business aviation. The traditional management model, where firms hid margin inside inflated fuel costs and marked up vendor invoices, is facing intense pressure from a new generation of tech-enabled, open-book management companies. These modern operators charge a higher, transparent monthly fee, but pass through all vendor costs, fuel, maintenance, insurance, and handling at pure cost with zero markups. This open-book approach aligns the incentives of the owner and the management firm. Under a pass-through model, the management company has no financial incentive to over-maintain the aircraft or push unnecessary charter hours simply to harvest fuel spreads. Their sole job is to run the operation as efficiently as possible in exchange for a clean, predictable management fee. However, the pass-through model presents its own economic challenges for the management firm. Without the hidden margins generated by fuel spreads and vendor markups, the firm becomes entirely dependent on its retainer income and charter commissions. If charter demand softens or fleet size shrinks, a pass-through firm has fewer levers to pull to maintain profitability. They cannot rely on silent margin aggregation to cushion operational down cycles. This brings us back to the fundamental truth of the business aviation industry. It is an industry that operates at the mercy of macroeconomic cycles. When the global economy flourishes, corporate earnings soar, and equity markets reach record highs, private flight hours surge. Ultra-high net worth individuals fly more, corporations expand their travel budgets, and charter demand skyrockets. During these boom periods, management companies thrive on high charter commissions and robust fuel margins. But when a recession hits, private aviation is often the first luxury expense to be slashed. Corporations cut flight department budgets to appease shareholders. Owners list their jets for sale, and charter booking volumes evaporate. Yet, during a downturn, the fixed costs of running a management company, maintaining dispatch centers, paying core administrative staff, and keeping facility leases do not decrease. A management firm that built out heavy institutional overhead during a bull market can quickly find itself over-leveraged when flight hours drop. This cyclical vulnerability is why vertical integration and fleet scale have become the dominant survival strategies in modern aviation finance. By controlling multiple touchpoints across the aircraft lifecycle, from brokerages that handle the initial purchase to management departments that operate the tail, to MRO facilities that perform the heavy maintenance, and charter desks that monetize idle hours, a consolidated aviation group can extract revenue across every phase of the economic cycle. When aircraft sales slow down, maintenance revenue from aging fleets keeps the lights on. When charter demand dips, management retainers provide baseline liquidity. Ultimately, whether you view a private jet as the ultimate productivity tool or an absurd financial money pit, the underlying economics remain unyielding. These machines are triumphs of engineering, but they are also relentless destroyers of capital if managed incorrectly. The next time you see a sleek private jet sitting quietly on a ramp outside a private terminal, do not just see leather seats, champagne, and effortless speed. See the complex web of capital, regulatory compliance, crew logistics, and insurance underwriting, operating continuously behind the scenes to keep that machine in the air. Understanding the economics of aircraft management is not just about understanding how rich people move around the globe. It is about understanding the delicate, high-stakes balance between capital efficiency, operational risk, and unyielding regulatory oversight in one of the most demanding industries on Earth.